Taxes are ultimately one of the biggest single expenses that any of us will have to pay, but with the UK economy struggling, the tax burden has reached some stratospheric levels that haven't been seen since the Second World War. So in this video, we're going to be discussing two of the most important and often overlooked tools that you can still use to pay less tax and build longer term wealth. One of them is only used by about 4.5% of people in the UK, and at the end of the video, I'm going to be debunking what I think is the biggest myth around these two tools that you can use. The first one is pensions. Now, pensions are not just for old people, so work with me on this one. Pensions have been fiddled with recently, and there's been plenty of speculation out there that there could be changes to things like the lifetime allowance and other of the key features of your pension. And this has caused some people to shy away. But with all that being said, pensions are still categorically one of the most tax efficient ways to build longer term wealth. And let's just debunk something very quickly that I've seen a lot of people get wrong. People say that pensions are bad value because you get taxed twice. Once when you pay in and then when you cash your pension out or start to draw down from it. This is categorically and fundamentally incorrect. And this is because any income that you put towards your pension pot is exempt from tax. So if you earn, let's say, £50,000 and contribute £5,000, you'll only be liable for tax on the 45k. So this is something right off the bat that we just need to get straightened out. But what is it about the pension that I think makes it so underrated and so often overlooked when it comes to the unstoppable duo of beating tax and building wealth? Well, the truth is, I think it comes down to a few key features rather than a single individual one. But arguably the most important one is this is one of the only investments you can make in your whole life where you can potentially double your money risk-free. Because don't forget, by making pension contributions, these can be matched by your employer. So that on its own can make the pension such a powerful tool for building wealth. Nothing in life apart from insider trading or being Bernie Madoff can guarantee for you to double your money like that. Then there's also the income tax relief. When you contribute to a pension, the government provides tax relief on your contributions. For every £80 you contribute, the government adds a 20 if you're a basic rate taxpayer. Higher rate taxpayers can claim an additional 20% or 25% if you're an additional rate payer. And then there's the annual allowance, which is currently £60,000 per year. Contributions within this limit benefit from the tax relief, but if people haven't used their annual allowance for the previous 3 years, then these can be carried forward. And this carry forward is a huge advantage. Whereas with most other tax advantage accounts, it's a case of if you don't use it, you lose it. Having this pretty generously sized allowance every year, but also being able to carry unused balances forward is just key goods. You've also got the tax-free growth. Any investment that you have sitting within a pension can grow free from capital gains tax and income tax. This means that any capital growth, interest or dividends earned within the pension fund are not taxed, allowing the fund to grow more rapidly over time than if it was to be taxed. You've also got your tax-free lump sum. When you get to the minimum age, I think it's 55 now, but it's going to rise to 57 in 2028, you can withdraw up to 25% of your pension pot as a tax-free lump sum. And you see people doing all sorts of things with their tax-free lump sum, choosing to overinvest in their pension and then using a portion of their tax-free lump sum from their pension to pay off their mortgage. There's so much you can do with it. That's to say nothing of the inheritance tax benefits. Pensions can be passed on to beneficiaries free of inheritance tax. If the pension holder dies before the age of 75, then the beneficiaries can inherit the whole pension pot tax-free. But if the pension holder dies after 75, then withdrawals are taxed at the beneficiary's marginal rate. This is again another feature that is so often overlooked, particularly, let's be honest, because it's a bit morbid, so apologies for that. But it can be a really good way of working towards building generational wealth. And the truth is, with inheritance tax rules potentially on the chopping block with the upcoming budget, then this may make pensions even more attractive. So what's the second of these tax-busting wealth-building tools? Well, enter stage left, the ISA. The ISA works in almost the opposite way to your pension. You get paid your salary, which has already had tax deducted, and then you can make contributions to your ISA from that, but you don't pay tax when you withdraw it. So that's a good way of thinking about it. So what is the ISA? For those of you that don't know, it's a tax wrapper that lets you invest while shielding your income and the gains from income tax and capital gains tax. But it's also worth mentioning there are a whole host of different kinds of ISA, but for the purposes of this discussion, we're going to be talking about the stocks and shares ISA. In my view, the others are pretty much a waste of time, especially the British ISA. That's proper dog shit. But again, only around 5% of people in the UK have a stocks and shares ISA. This is a low-key tool that so often flies under the radar and is so often undervalued and underutilised. And you don't have to spend very long on this channel to work out that I think the ISA is, again, one of the single most important assets available in the UK when it comes to building wealth and paying less tax. But let's get into the nitty-gritty. Why is it so good for both paying less tax and building wealth? I think, like with the pension, it comes down to a few key features. The first is the tax-free growth and income. Investments held within an ISA are free from capital gains tax and income tax, which makes them super tax efficient. This isn't a drag on your investments that you'd have to be factoring in if you were using potentially some other vehicle to invest. You have no tax on withdrawals. Unlike pensions, withdrawals from your ISA are completely tax-free. This makes ISAs highly flexible, and you can access your money at any time without worrying about annoying charges or getting a big tax bill at the end of the year. And I think it's this flexibility in the withdrawal rate which makes it much more usable than a pension, but each has their place, which we'll come on to in a moment. The pretty generous ISA allowance. Each year you can invest up to £20,000 across your ISA. This allowance can be split between different types of ISA, cash ISA, stocks and shares, lifetime ISA, blah blah blah, but most of them are pointless. And the truth is, that limit is pretty generous. Less than 0.5% of people in the UK maximise their ISA allowances every year. And the limits are so generous that they apply to individual people. So if you and your partner have 2 kids, that's a total of nearly £70,000 every year in tax-free allowances. If you're putting that kind of money away, I've got news for you. Money-wise, you're fine. You're all set. Don't worry about it. By holding a mix of pensions and ISAs, you can control how much taxable income you draw down each year, potentially keeping yourself under lower tax bands whilst accessing tax-free cash ISA funds. The big mistake. At the start of the video, I mentioned that there is a big myth I think people get wrong, and that is they assume that they should go balls to the wall on either their pension or their ISA. And the truth is, that's absolute nonsense. But the truth is, they're tax advantaged in different ways, so they should be used in different ways. In my view, both your pension and your ISA, to say nothing of the different kinds of ISA, fulfill different roles and purposes in your financial journey. An ISA is a more flexible account that has fewer restrictions on when you want to access the money. You've got generally a greater choice about what you can invest in, and the penalties for withdrawing are virtually non-existent. So maybe that's what you use to help your kids get through university, to get on the property ladder, or to buy your next home. But a pension basically includes free money up to the point that your employer will match contributions. So in conclusion, what have we discussed in this video? Well, the main thing is that whilst taxes in the UK remain historically high, as well as high compared to some of our international counterparts, there are still tax advantaged accounts that allow you to build wealth for you and your kids whilst managing your tax bill. But the key thing is, these accounts are so infrequently used, and even more rarely are they fully utilised. And so I think this means that they can often fly under the radar and they don't necessarily get the credit that they're due. And I think it's generally sound wisdom is to contribute as much to your pension as your employer will match. That's free money, and there are very few free things in life or in the investing world that can guarantee you to double your money and give you tax relief. And you can also use your pension if you want to duck below certain tax thresholds where you might lose a government benefit. And then any investing you want to do beyond that is where an ISA starts to make a lot of sense. You get the flexibility of being able to access the money more easily and readily, but you also have your pension to fall back on for when you retire. And just one final point on this. As I've alluded to in various parts of this video, there's speculation abound out there that there's going to be a whole raft of changes to ISAs or pension rates and blah blah blah. But the truth is, that's always out there, that's always a concern to people. And in my view, I personally don't let the possibility of some of the changes coming from pensions and ISAs to dissuade me from wanting to use either of them.